Welcome to the Simpler Options video for March 26, 2015. My name is Don Kaufman. I'm actually filling in for John Carter, who is away on business over in China. And I've just recently joined Simpler Options in the last 2 months. Prior to Simpler Options, I spent approximately 15 years in the brokerage industry. Specifically, I've been around at Thinkorswim TD Ameritrade really since build 1 of the Thinkorswim trading application. Before that, I spent a few years in the professional trading world in Chicago as both a trader and risk manager. Now, today's focused. First and foremost, you'll see that I'm actually doing this video with about 5 minutes to go to the close. There's fairly extreme markets today in that the S&Ps are down some 32 points. We are at lows of the session. I thought, what better time to talk a little bit about volatility than when they're in the midst of volatility. The other point that I want to make, and I've noticed this as of late, I'm much more of a quantitative trader. And what a quantitative trader really means, I look a lot at relationships, okay, between one product to the next. And one of the relationships that's really at the forefront of this discussion is specifically the Russell. Okay. Now, you may not look necessarily at the S&P futures. You may not look at the Russell futures. However, I'm going to urge you that if you don't, these really should be on your screen. Now, maybe you don't want to look at a futures contract. If it suits you, instead, possibly pull up the spiders in the IWM. The reason I bring this to your attention is because the Russell has really been at the forefront of almost all the major moves that we've seen lately in markets. In this particular case, so I've highlighted the Russell here, and I'm going to go over to a chart. And I'm actually looking right now at a 1 day, 1 minute. And I'm not trying to get you to be that myopic and go all the way down to a 1 minute, but I thought it gave nice inflection to what's really gone on today. And if you take a look very carefully at the open of the markets, granted, of course, I am on Pacific time. You can see the market here opens at 6:30 in the morning. It's bright and early. Okay. Again, just a few minutes left to the close right now. Right out of the gate this morning, the Russell was weak. Okay. Didn't really bounce when the S&Ps bounced and continued, okay, this slide throughout the course of today. And that's something we've actually seen day in and day out, is the Russell has been leading the S&Ps around by the nose. If you take a look at the S&Ps, which are in fact down 31 right now, on a percentage basis, they're faring much better than the Russell has fared today. But take a look at really the same time period all the way down to a 1 minute and what's gone on inside of the S&Ps, which, yeah, they sold off a little bit at the open. They rallied back to almost completely flat twice. And then, of course, some of the selling persisted. And on an intraday basis, which you may find unique in this case, is again, an intraday basis, you had a little bit of a heads up. The Russell was leading us lower in markets. This is not so much maybe looking at bonds, so forth, but really looking at the relationship of one major index product versus another. Additionally, there's a product that you may or may not be familiar with, and that is a volatility future. Now, so many of us, we have tendency just to look at the VIX. Ooh, look at the VIX, look at the VIX, look at the VIX. But the VIX, it's nothing more than an equation. Okay, it's not. The VIX is not this tangible product. And I always ask this to people, and I go, can you trade the VIX? And they go, sure, Don, you can trade options on the VIX. No, that's not what I asked. Can you trade the VIX? No, you can't trade the VIX. Okay, you can trade the VXX, but the VXX is actually based off of short duration volatility futures. So my question again, what matters more? The tangible product that you can trade, which are the volatility futures, or the VIX, which is nothing more than a calculation. In this particular case, I've gone and I've opened up the volatility futures. And you can see I've actually switched from the active contract to all contracts. Because what the volatility futures give you is a read on risk in a 20-day time window, a 55-day time window, an 83-day time window. And you'll actually see that volatility moves differently dependent upon the time frame. In this particular circumstance, with 20 days remaining, volatility has actually moved up in one of the shortest durations more than it's moved up, okay, in the 55-day duration. Why do we take a look at this? And again, to give you a little bit of insight here, what traders like myself will look for is to kind of gauge how serious is this initial move down. Well, okay, you might think right now by looking at your positions, it's plenty serious, Don. I'm down X amount of money. No, what I'm trying to actually ascertain is, are we really in the midst of what's the beginning of some chaos, some serious volatility? And what traders look for is they look for short duration volatility, which is, for instance, it could be a 20-day or a 19-day or even an 18-day. We look for short duration volatility, which is right now trading at 1665. We look for the short duration volatility to eclipse the longer duration volatilities. Okay? What that means is that risk is imminent. It's here. It's now. It's inside of the next 20 days. It's on. Okay? There's the bell in the day. We closed at the lows of the session. But the one thing, okay, that you have to realize here is that although volatility came up today, it doesn't necessarily mean, okay, that it's on. When I say it's on, okay, if this short duration volatility had exceeded the May volatility, the risk we'd be seeing in the market, all right, would be substantially more serious, that there could be some real follow-through in the coming days. Okay, this is what you want to look for. Coming into Thursday, Friday morning, we're actually going to see what's called the final GDP number. It's actually GDP of the fourth quarter of 2014. It's the final revision over there. That GDP could rock markets over there. We want to see, again, if there's follow-through to some of the selling. Does risk become imminent? Does the short duration volatility actually go above, okay, the longer duration volatility? And if it does, that means some serious volatility could be here to stay for a while. Thanks a lot, everybody, for joining me for this video here for Simpler Options. Again, my name is Don Kaufman. Be back in the near future. Thanks a lot, everybody, and bye-bye.